Ladies and gentlemen, welcome to Entrepreneurial Finance, pure investment companies, so pure venture capital companies. What are pure venture capital companies? Well, you can see typical venture capital companies on this slide. We already talked about Sequoia Capital, the entrepreneurs behind the entrepreneurs. European Founders is probably the same thing, the founders behind the founders. So kind of like sounds the same. 3i. They all invest in early stage companies, high uncertainty, make equity investment, help those founders to build their businesses and do that for capital gains. The goal is to make money. This is a typical venture capital company. So how does the venture capital company organization look like? Well, it all starts with a management company, with some people who are going to investors and tell them, I want to raise a fund. Please put some money into my venture capital fund. And ideally, these investors do that. For example, pension funds put some of their funds into venture capital. And this is how the management of a venture capitalist raises a fund. And when they have closed the fund, this venture capital fund, they start investing the fund. And this is actually also why it's called formal equity capital, because it is a formal organization, a venture capital fund with its management investing into portfolio companies. Okay, if the fund is closed, then the management company starts to select and taking care about portfolio companies. So they select the companies and they try to help them to build their businesses in order to grow the value of these companies. And when the value is high enough, they have to exit these companies because this is their business model. This is reaching the goal of making capital gains, buying low, selling high. And only if a company has a higher value and there is an exit possibility, then they try to exit that to either financial investors or industrial corporations or on the stock market with this public investors, and then the money returns into the fund. 80%, and when the fund is earned back, 80% of the profits go to the investors in general, and 20% go to the management companies. This is how there's also an incentive for the management company to select interesting portfolio companies and make interesting exits. And besides that, management company also get a management fee, which is maybe 1, maybe 2% of the whole venture capital fund per year. So this is the formal organization of a venture capital fund. This formal organization has two consequences. The first consequence is, if you as an entrepreneur have a venture capital fund as your investor, you have to know that these funds are never evergreens. So they are not there forever. They have a duration which is 8 years, 10 years, 12 years. So after 8 years, 10 years, 12 years, they have to pay back their investors. This is why they have contractual details like drag-along rights, because what they want to do is they want to drag you to sell the business. That's the one thing you have to know. The second thing you have to know, it is a portfolio business. And a portfolio business means if you have a higher risk in the portfolio, you have a higher return in the portfolio. So venture capitalists are not interested in companies who make slow steps, slow developments. They need more risky investments in order to have high returns. And they know that out of a portfolio of 10 companies, only 2 companies are there for the returns. All the other 8 are either dead or living deaths. But they will work with the 2, and out of these 2, they hope to make their WhatsApp story being sold for 19 billions. This is how venture capital works in general. Now, if you look at that, and this is the third consequence, if you look at the investors of venture capital, you will see that, for example, this being a pension fund, and this being a big fund like PIMCO, for example, they probably do not only invest in one venture capital firm, but in more than one. Leading to what you can see in practice, that venture capital investments normally take cycles. A typical cycle of venture capital investment is starting with a good stock market, high demand for new emissions. What we have right now, more and more money is flowing into venture capital. You can see it right now in Germany, for example, that more and more corporates try to build corporate venture capital firms. That's a typical phenomenon in this state. If you have that phenomenon, normally it leads into an oversupply of capital. So the deals in the market are less promising, the investment prices rise, and having said that, when the stock market is going to turn bad and you do not have exit anymore, you have falling returns of VCs, you have decreasing capital inflows, and VCs might disappear. So VCs get unsuccessful. And this is when the investors who see that normally tell their VCs not to invest in a certain industry anymore, for example, leading to the so-called paradigm shifts which we have seen over time. Like in 2000, 2001, when everybody invested in the 90s into internet companies, the bubble bursted, nobody invested into internet anymore. Everybody wanted to invest into biotech companies building products in the 90s, and then venture capital companies saw it's too expensive, so they stopped doing that. They invested into tool companies. These typical paradigm shifts is also a consequence of some investors being invested in more than one venture capital firm, changing their minds and influencing the venture capital scene. And the venture capital scene normally is following each other, and what you can see there. And in a state of weak stock market and less capital inflow, you will see if the market recovers, then the cycle starts again, which is a typical venture capital cycle. So in general, this is the organization of a venture capital company, and this is how they make business. And you as an entrepreneur, you have to know that in order to get along with your VC.